Hi everyone, Mina here with JMac Home Loans, and today I wanted to talk about how exactly the amount of months you need to put into your Impound or Escrow account when you do start that up is calculated. Because depending on the amount of months you need to bring in is going to be a little bit different. And so before I get into the Impound and Escrow account with property tax reserves, I do want to preface it with how mortgage payments typically work. And so with mortgage payments, the principal and interest will go to the servicing company your loan is with. And then at that point, of course, the property tax bill due twice a year to the county, and then also the home insurance bill, which you can set up the payments accordingly with your company that you have your home insured by. And so rather than managing all these different items on your own, and especially the property tax bill, those are pretty hefty payments that you have to make twice a year. Rather than making those payments on your own and managing and saving up and making sure you're taking into account those bills as they become due, you have the option to set up what's called an escrow or impound account. And that account will allow you to make one payment to the mortgage company every single month, and they will take care of dispersing the funds when they become due. So all you have to worry about is making the monthly principal, interest, taxes, insurance payment to one place, and they'll take care of the rest. And so when setting up this type of account, you do need to come in with with a certain amount of months of reserves. And so that account needs a 3-month cushion of your property taxes in reserves at all times. And so that means that every month when you get your mortgage statement, if you do have an escrow or impound account, you'll be able to see what balance is in that account. And so I always remind everybody, it's not an additional cost to have this account, but you do have to, put in those 3 months of property taxes depending on what your property's worth. If you're purchasing, if you're refinancing, whatever your current property tax bill is, 3 months of it has to be in that account at all times. What month and how many months of payments you're going to make before that bill becomes due. And so I'm going to explain really quickly through a screen share. Okay, so in this example, let's say that you're going to close on your home loan in the month of June. And so first off, friendly reminder that mortgage payments work backwards in a way where basically if you have a close date in the month of June, your first payment is actually not going to be until August. And what the August payment is going to pay for is all of July that you own the home, and of course any interest you owe on the loan, which once you do close on the loan, you are accruing interest. And so anyway, close date of June means your first payment is in August. And so now how exactly however many months needed at the close date of June is calculated for the property taxes is again based on when is the property tax bill going to be due, and how many months do we need to make sure that the impound or escrow account needs to have within that account once the property taxes are due. And so property taxes in Orange and LA County, they're due in November. And so if they're due in November, what that means is by the time we hit November, 6 months of property taxes are going to be due. And of course, like I mentioned, in the escrow or impound account, if you do choose to have it, you need to have a 3-month cushion in the account at all times. And so every month when you make your payment, you're adding a home insurance monthly payment and a property tax monthly payment into your impound account every single month. And so the way it's calculated when it comes to how many months you will need if you were to close in June is going to be, okay, now we know that we need that 3-month cushion, the 6 months that's due, in the account by the time we hit November. So that's going to equal a 9-month property tax month of, reserves or however much money we need in that account at the time we hit November. Because again, at this time, 6 months is going to be dispersed to the county, and the 3-month cushion that's always needed is going to be left, which is just what we need. And so if we're closing in June and your first payment is in August, we'll calculate out, okay, August you make your first payment, you're adding an extra month of property taxes into your impound account. So we're good with August. September payment, you're adding another month of property taxes. October payment, another month of property taxes. And so now, once we hit November, we need to have 9 months in the account. And so what that means is, okay, if we're only going to be adding into the impound account 3 months of property taxes before we hit the point in time that the property taxes are going to be due, and we technically need 9 months, then what we're going to do is, okay, that means that at closing, if we're closing again in June, you're going to need 6 months of property taxes, tax reserves in that account to start up the impound account. So at that point, once you make your payment in August, September, October, and once we hit November, you're going to have 9 months that's needed for the property tax bill to be paid and the 3-month cushion to be left in the account. So I know with the impound and escrow account reserve calculation, it's kind of a confusing topic. I know for me too, 7 years ago when I got a mortgage, I was kind of like, how exactly are these months calculated? But yeah, bottom line, it's based upon how soon is the property tax bill going to be due. And at the end of the day, the reason why this isn't an additional cost is the 6 months that's due in November, you're gonna have to pay for either way. It's the only difference between having the impound or escrow account or not is you're setting aside that money on your own. And with the escrow and impound account, you do have to have that 3-month cushion in the account at all times. But friendly reminder that you do get that money back if you ever sell your home, refinance, whatever it may be. So it's not a cost you're giving anybody, and you'll always be able to see the balance in that account at all times on your mortgage statement.